Hi, and welcome to How Was I Supposed to Know That? My name is Bernard Williams. I'm the host, and I'm also the managing partner of Company Counsel LLC. We're a small business law firm that works with companies that are on the move, that are growing and scaling, and need support to make that happen. A lot of what we do is in the M&A realm, and one of the things that I find pretty frequently in the M&A process is that my client, the seller of the business, the owner, finds that they are not quite prepared for the emotional element that uh, that's just a part of that sale process. They've probably spent many years, if not a lifetime, growing a company. When it comes time to prepare to sell or to actually go to the closing table, they find that what they expected and what the reality are not necessarily the same. So let's talk about it. This is a podcast that is designed for small companies and small company owners, where we shed light on the surprises that they encounter throughout the business ownership process and the M&A process. So let's shine some light on the emotional element of M&A today. And joining me for that conversation, very happy to welcome Jonathan Peters. Jonathan is a senior partner with Empirical Consulting Solutions, and I'm really happy to have him in the studio today. Welcome, Jonathan.
Thank you, Bernard, and thank you for having me here this afternoon.
So if you don't mind, why don't you start by telling us a little bit about what you do at Empirical Consulting Solutions?
Thanks. So, yeah, Empirical Consulting Solutions, a firm that's been around now 14 years. The managing partner started it up to focus on the lower middle market companies. And essentially, we help create value in privately held businesses, private equity-backed businesses, but in all aspects that we can bring resources and bring experience to the table. And what's interesting about the three managing partners and myself, we come at this as operators, not necessarily consultants. We've all been there. We've all been running some pretty big P&Ls, and at this point in our careers, we're thinking about things as being an operator and helping business owners to achieve value doing that.
So how is that different? How is acting as an operator different from acting as a consultant? What does that look? How does that look different on a day-to-day basis?
There's some consultants that come at it more from a theoretical or a academic standpoint. We're coming at it, that's our name, empirical. We're coming at it from looking at diving deep into the business and looking at all aspects of it and just looking for opportunities to create value.
Great. And you mentioned that the firm was founded with a focus on the lower middle market.
That is correct.
How do you define the lower middle market?
So in terms of revenue, probably down to maybe 10 million, on up to that 100 to 200 million. There's certainly outliers on both ends, but that's typically tends to be our sweet spot of where we focus.
Okay, perfect. One of the things you heard during the introduction that I began talking a little bit about M&A and the emotional component of getting that M&A process. Is that something that you work with owners on? Is that something that you've seen in your experience working with small company owners?
There's always a lot of emotion in terms of, look, owners have put blood, sweat, and tears into their business over many years. They missed vacations. They, just put in long hours, weekends, et cetera, whatever needed to be done. We're truly working in the business. So we come at it from an outside perspective, being able to offer an objective view, taking the emotion out of it, particularly when they are thinking about going to a transaction or even going to the next generation. I use the phrase quite a bit, and I don't think it's overused, is that a lot of times founders and owners work in the business and not on it. There's always many things to do throughout the day. There's a lot of things that just have to get done. Doesn't always give the space or the time for the owner to step back and really see the bigger picture of what would enhance value and really position the business well to get a higher value.
Now, is it just a matter of bandwidth? They spend so much time focusing on answering emails and returning phone calls and selling and all the things that are a part of running the business, there's just no time to focus on working on the business? Or is it more of an energy distribution?
I think it's more of a conscious effort to say that I'm going to step back. I could stay busy all day long in the business, but I'm going to carve out some time to look at my pricing strategy as an example, or I'm going to take a look at my supply, my supply chain and what's happening there. Just two examples, but it's something. It needs to be a disciplined and conscious effort to be able to step back and look at the business more objectively.
Mm-hmm. So what percentage of an owner's time would you recommend they spend looking on the business, sort of with a bird's eye view strategically versus working in the business?
I think the question that really varies as to where is the business at, how well is it performing today, what is the time frame that they're looking to either go to a transaction, or like I said, it could be a multi-generational transition. What's the timing? And I think that the closer you get to wanting to exit the business, more time needs to be focused on that. But here again, you got to start thinking about this 18 to 24 months before you're even contemplating exiting the business.
Okay, so it sounds like the closer I get to exit, the more important it is for me to remove myself from the inner workings of the business as an owner and focus more on working on the business. Is that right?
For a number of reasons. One is, yes, to be able to have that strategic view, but I would say also any buyer or the next generation cannot be dependent upon the founder or the current business owner having to be there day to day in order to keep the wheels on.
Mm-hmm. Tell me a little bit more about that. Why is that the case?
Well, I think from the standpoint of an ongoing and sustainable business, and if an owner truly wants to exit, the business from an operating perspective cannot be dependent upon that individual being there. Mm-hmm. Secondly, whether it's an investor or potentially a PE firm looking at it, they're going to place a higher value. They're going to put a higher multiple on a business that has a sustainable management team, not dependent upon the founder.
Okay. So it's one thing to have key employees, and that's fine for a buyer. But if that key employee is also the owner, then that creates problems.
Correct.
Do you agree with that?
Okay. Absolutely. Yeah. Yeah. It's not sustainable when that person steps out.
In your experience, do business owners find it difficult to step out?
Probably for several reasons. One is there's that emotional connection to the business because they founded it. They, like I said, put blood, sweat, and tears into it. Mm-hmm. I think there's also it's their baby, if you will, and they want to make sure that the baby goes into good hands going forward.
Now, what about companies that have multiple founders? How does that dynamic play out when there's more than one owner of the company as they approach the sale?
Well, I think that varies, and that's a whole very deep topic for probably another discussion. And there's others that are much better at diving deep into that topic. But I think alignment is critical. That all of the partners, all of the family members, whatever the case may be, are aligned in exiting the business and what they're trying to achieve and how they're going to achieve it.
Mm-hmm. And so how do you go about creating that alignment?
Well, I think the questions around what are they trying to achieve? Are they aligned on the value of it? Are they aligned on the timing? The desired buyer, whomever that may look like, So I think there's just a whole host of things there. Like I said, and that could be a very deep topic in itself in terms of multiple stakeholders and gaining alignment there.
Okay, that's fair. So let's go back to more of a, I don't want to call it a simpler topic, but maybe one that's a little more digestible. The concept of the founder-led company, and that founder is ready to sell, and he's thinking maybe 18 and 24 months out. He'd love to close, maybe go off and do something totally different after. In that 18 and 24 month time period prior to his exit, what kinds of things should that business owner be thinking about to prepare for the sale?
Mm-hmm. That's a really good question. And we do assessments like this all of the time where we will do a deep dive in that 18 to 24 months out before desired transaction, looking at a whole host of things, starting with the balance sheet, what condition it is, how healthy is it, is there an excessive amount of obsolete or slow-moving inventory that needs to be cleaned up and decisions need to be made on. What does the AR look like? Are there agings out there that they're not collectible? So just from a balance sheet perspective, what needs to be cleaned up? From a P&L perspective, just starting with the revenue, what does the last 3 years to 5 years look like? Was it very episodic, or were there spikes, or is it fairly predictable? Nobody likes risk. Nobody likes unpredictable revenue. And if there is some explaining that needs to be done, get out in front of what happened. It could have been COVID, for example. Everybody had spikes during 20 to 23. But
Right.
beyond that, was there a supply issue? Was there something? But when you have a kind of a smooth trajectory, both in revenue and earnings, that's an easy story to tell. Otherwise, you got to get out in front of it. Look at gross margin. That is indicative of either pricing discipline. It could be on the supply side in terms of supplier relationships. We look at customer stratification. Many times, a small amount of customers will make up a majority of the revenue that introduces risk. So customer concentration, what does that look like? Many times owners will put too much emphasis on what they call the A customers. Well, at the end of the day, those are the lowest profit customers. What's happening with the B's and C's? And an acquirer or an investor is going to look very closely at that. And then as you get down through the middle of the P&L, just what do the operating expenses look like? Here again, are they fairly predictable, or are there a lot of spikes in there? And if so, being able to explain that.
Now, these are all things that the owner should be focused on from day one, correct? I mean, even if they're not interested in selling within the next 24 months, aren't these all just healthy business management principles?
Absolutely. And when we do a deep dive on something like that, it will typically lead to 2 or 3 areas that need attention. And then we will work closely with the owner to agree on a project plan. And I'll give you an example. In some cases, an owner might say to us, we have a revenue problem. And we peel it back, and well, the revenue necessarily isn't the problem. Your problem is in supply chain. You're buying the wrong inventory, tying up working capital. Therefore, you cannot fulfill orders, and then therefore you're stagnant on your revenue. So we'll kind of peel that onion back and really understand what is the root cause of the issue.
And this is all part of the assessment process that you do in these early planning stages, right?
Correct.
So as the owner of my own law firm, as a business owner myself, I can only imagine receiving one of these assessments and being surprised by the results, maybe even being insulted by certain findings.
Yeah.
Have you ever had that experience? That somebody feels insulted, or do they feel like they have to defend themselves based on what the assessments are showing?
I think as a business owner, it's fairly easy to be defensive. You're very proud of what you've created. You think everything is running great. again, you've spent so much time in the business, but when you have an outside objective lens looking in, it's yes, it's very easy to become defensive, but after digesting it, many times the owner says, "You're right. Now, let's get our arms around this and get a plan."
What is that process like? Going from the defensiveness, the anger, not wanting to accept the results, move from that to get into a place where you can say, all right, I'm ready. I've moved past that. Now let's go. Is it a matter of days? Is it a matter of months? Or are you involved in that process, trying to help them to shift their mindset? Can you tell me more about this?
I think it's different for everyone, and again, it's situation dependent. But for the most part, many owners will look at it and say, "Yeah, you're right. I hadn't thought about that. So let's talk more about that. Let's get aligned on what does a good gross margin look like. Now let's detail a plan of how we're going to get there." We've worked with some privately held businesses. One comes to mind, just through customer stratification, not necessarily pricing, but just customer stratification, focusing on the right segments of the business. We were able to increase his gross margin by over 500 basis points within a year's time. And that made a significant impact to the bottom line.
I can imagine. It's great results.
Yes.
Okay, so getting back to the timeline, you've now given the owner the assessment. He's worked his way through the process of shifting from defensive and angry to acceptance and ready to go. So what's next? I mean, I imagine there are differences depending on what the assessment showed, but I mean, talk to me a little bit about the journey over the next 18 and 24 months and how you help that owner to actually prepare for the close.
Well, I think it's important to take the areas that could be worked on and prioritizing them. Meaning that if you think about a 4-block, there's some initiatives that are going to be very easy to do, but have a high impact. We'll certainly get right after those. There's some that may be high impact, but a high degree of effort. Assess, do you have the team? Is the team ready to do it? And if so, get after those. Then there's going to be some that's a high degree of effort with a fairly low impact. And then there's going to be low impact, low effort. Just kind of discard those, but prioritize the areas of opportunity that we see. Some of those the decision may be just call them out to whoever is looking to invest, but don't do the work. And in other cases, yeah, it's fairly significant to do the work now in order to maximize the value for the transaction.
Is there a danger in trying to fix too much at once?
Absolutely. There's a capacity of any team or capacity limit of any team. There's also a capability limit of any management team. So really assessing that softer side, as well as, yes, it needs to be done and it would drive value. Can we do it? And do we have the resources to do it?
So you've talked a lot about the numbers and about some of the tangible things that sellers can do to improve the valuation of their company and to prepare for sale. What about some of the intangible things? What intangible factors might influence whether or not a deal is closed or how a seller views a prospective transaction?
Well, we talked about some of them already. The quality of the management team is really important because that's whether the business can be ongoing with pulling the owner out or the founder out. I think that there's other softer things, level of engagement, retention of employees. If there's a really high turnover, that's indicative of culture or a culture issue. That's something that can't necessarily be fixed overnight. There is customer retention. That's something that, how sticky is the customer base? How predictable and recurring is the revenue because of levels of customer service? There's a number of intangibles there that can either put top spin on the flywheel or could actually slow it down.
Okay. So I'm sure you've worked with, I'm not going to estimate how many companies you've helped to improve their valuations and to close these sales. I'm sure you've seen mistakes. Can you share a few, without giving any names, can you share a few examples of maybe owners who did the wrong thing, maybe they didn't listen to your advice, and some lessons learned?
There's probably a number of examples that we could give, but it's really where the owner is not open to listening or is just doesn't support the idea and just says, no, I'm not going to do that. And at that point, it's better that we shake hands and you know, we only want to engage where we can see that we can be successful. And that's effort on both parts, not only our part, but also on the owner's part and the management team's part. So when we're aligned, when there's good agreement, then yes, we can definitely get the results done. If that's not there, the inverse is true.
So what kind of thing? I mean, I guess I can't imagine why a business owner would engage you, then not take your advice, or or not do the things that you tell them could help them to close their deal. Do they give you? Is there specific pushback that they give you, or are there reasons why they're reluctant to implement those changes?
Perhaps they don't want to make the investment of either time or money, where they feel that it's good enough to take the transaction. But it's usually a conscious decision of, you know what, we're not going to make the effort and time.
Mm-hmm. How often do buyers, I'm sorry, not buyers, how often do sellers pull out for emotional reasons that it just doesn't make any sense on paper, it doesn't make any sense logically, but emotionally that seller decided, you know what, I don't want to go through this. You ever see that?
I have, where their other alternatives came into play. And I can give you an example of an environmental services company that we worked with, where it was actually, they wanted to transition the business to the third partner, and the two founding partners wanted to exit and move into retirement. As they did this assessment, as they saw what effort and what amount of time and money would need to be put in order to position the business to get to this third partner and be successful, they opted then to go to transaction. And they just said, you know what, it's better just to take for what it's worth today, as opposed to betting on tomorrow.
Right. And as long as they're satisfied with that decision, I guess all's well that ends well, at least for them, right?
It did work out well. It did work out well all the way around.
So as we start to come to a close, are there any pieces of advice that you'd like to share with our audience that could help them to maybe avoid mistakes and have successful transactions?
I think really it's where we all started, is that don't wait until time is ticking and you want to exit. Start the process, do the assessment early on, and give yourself time to make decisions as to what you want to work on, what you can do to enhance the value of the business, versus call out where the opportunities are to a potential buyer, but say, I'm not, that's going to be for the next owner to do that work. But it's really starting in advance in thinking about things and doing the assessment.
I love that. One of our core values is that we live by proactive protection. So I love the idea of being prepared, thinking ahead. I like what you're putting down, Jonathan. So in terms of you and your own business, does Empirical Consulting Solutions have any exciting programs coming up? Anything you'd like to announce?
We have a host of initiatives going on right now in multiple fronts. From an operations standpoint, we've just upskilled our operations team, where we can do value stream mapping. We can go in using Lean Six Sigma principles. And I know that sounds maybe over the top for small business owners, but the principles itself will help diagnose where are pain points, where is there waste, where are there opportunities. And whether it's a $200 million business or a $20 million business, we use those same principles to be able to map that out. There's other areas. This exit readiness is a big focus in our area right now. For what, like I said, whether it's privately held businesses or even private equity backed portfolio companies, really we've put together a defined project to be able to do that.
That's great. That's great. And I'm sure that exit readiness program covers a lot of the things we spoke about during this podcast. So I would imagine.
That's correct. That's correct.
And what's the best way for people to get in touch with you if they want to find out more?
So you can reach out to me directly at jpeters@thinkempirical.com or visit our website, www.thinkempirical.com.
Great. Terrific. Well, this has really been an enlightening conversation. I've enjoyed talking to you, and I appreciate all the insight that you've shared. John,
well, thank you. Thank you, Bernard. It's been a pleasure to be here.
The pleasure is all mine. Thanks so much.
All right.
Another episode of How Was I Supposed to Know That? Thanks all.